This is the $1 trillion show for, what is today? February 4th. I can't believe it's February already. We have spent all of January dealing with payroll because January 31st is the deadline for that. And I hate payroll, which is why I hire other people to do it for me. But yeah, so we're past January 31st, and now we are into regular tax season when people are starting to get all their paperwork, phones starting to ring off the hook. People are complaining, you didn't pick up my call. We called you back within a few minutes, but okay. Anyway, if you're watching, our office hours are 10 to 6, and we take lunch at 1. So that's the time you should expect people to pick up. But yeah, we've got Sammy up front. He's manning the phones, and he's calling people back if we don't catch them immediately, which is great. All right, so this is the $1 trillion show, like I said. And what is the $1 trillion show? Who am I? What are we doing here? And I am your host, Neal McSpadden, and this is Sarita. She is our operations maestro, and this is the $1 trillion show. So what is the $1 trillion show? It's the mission. The mission is to $1 trillion in taxes. That's really the mission. I want to save Americans $1 trillion, and that's why we're going after the $1 trillion show. So that sounds like a lot, especially for one tax firm, and it is. And that is impossible to do as a single firm. So even if we were the size of TurboTax, right? If we were the size of TurboTax, we could get it done, to be honest. But realistically, there is no way for enough clients to be clients of ours in order to save that $1 trillion. So the way we're going to do this is we're going to scale tax strategy through technology. And technology like this, live streams, courses, tools, all kinds of stuff that we're putting together in order to make these tax saving strategies available and accessible to people. As an example, we'll get to the example in a second. Who am I? I'm the guy who started Tax Sherpa because I owe the IRS $1.3 million. That was the start of my tax journey, and it fixed my own problems. I got into this world. Let's get back to the what. Starter course. This is one of the courses. We've got the starter course is up live. We've got another course coming out on Friday, actually. And then just because I felt like throwing together yet another platform or another course, I got that up this morning. So everybody who's in our Explorers group or our Navigators group should have gotten an email about that. And this was added to our portal. And I'll show you what it looks like. So this one is Beyond Passive Income, the Real Estate Investor's Playbook for Beating the IRS Legally. And what this is about, this is a short course. It's 20 minutes worth of videos that I've recorded, and there's company resources and all this kind of stuff. And it's tied into an AI powered tool that I created that was trained on the IRS's rules from publication 925. And all that is to say is if you have other income, like a day job or something, and you have a real estate portfolio, most of the time you're actually not able to capture all the deductions you're entitled to because you're in passive status. So there's passive activity loss limits. So what this course does is it shows you or tells you what those are and then how to get out of that, because there's 8 different ways to get out of that trap. And then once you're out of that, then you can apply more deductions against your day job income and potentially do cost segregation as well. And the course goes into all that. So this is a free course I put up today. This is a tool. Everybody who's in our Explorers group has access to it. So an Explorers group is free, right? So anybody can access this whenever they like. And I'll show you at the end of the call or the end of the show here exactly how to do that as far as how to access all that. But these are the kinds of tools that we're developing. So it's course in this case it's courses plus AI that is trained on how the IRS works, and then it can bring you into more tax savings. So if every real estate investor went through this course, I don't know if we get to $1 trillion, but it'd be a lot. It'd be billions. There's so much real estate out there. And this is for investment real estate. It's not for your personal house. So keep that in mind. Okay, so that is the kind of stuff that we're doing. And that's how we're going to get to our $1 trillion mission. With that said, the main deal of the $1 trillion show, though, is people have questions. People always have questions. And I have the answer.
Always have questions.
I have the answer to every tax question. The answer to every tax question is, it depends.
It depends.
It depends on what we call facts and circumstances. It depends on what's going on in your life and what are the facts surrounding all of those things. There's all kinds of examples, but what is true for you is not necessarily true for your neighbor. right? Because what they're doing and how things impact them is going to be different than what you're doing and how things impact you. Very simple example. I browse tax Twitter. So X has all these people who tag tax Twitter, all these tax professionals talking about stuff. And I saw one today that says, it was talking about the difference if you earned like such amount of income as a W-2, I think it's at $150,000. If you earn $150,000, you can pay income tax, you can pay payroll tax. And if you earn that same $150,000 as dividends, then you would pay a lot less in tax because of the qualified dividend rate, which is true. You have to say, what is going into that income tax number that person put out there? It depends. Are you single? Are you married filing joint? Are you head of household? You're married filing separate? If you are married filing joint, does your spouse have income that adds to the overall household income, which adjusts the rates? So immediately, on the most basic level, it depends. Basically, what we do here in this show is we talk about all the ways it depends as the questions are unraveled. So I don't know what's coming. Serena compiles all these, and then she just throws them at me, and we'll see. We'll see how we work our way through this. So, Serena, what do we have on the list for today?
So we do have a real estate question.
Perfect.
Yep. So a client wants to know if someone wants to do a 1031 exchange but can't find a new property in time, what can they do to avoid paying taxes?
So this is a funny question because this is one where it doesn't really depend. So either you meet the timelines or you don't. There are all kinds of stories in the real estate investment world talking about this situation where they have a 1031 and they need a property now and they're just looking for any kind of anything that they can roll it into. If you miss the deadlines, which is basically a 3-month and a 6-month deadline, then it's taxable. That's basically it. I'm not aware of any exception to that if you miss the deadlines. Now, there are other things you can do, though, like reverse 1031s, where you buy that property before you sell the other one. I was talking to a client this morning who did that last year with a condo. But yeah, if you miss it, it's taxable. So here's the question. In that situation, is it worth buying a bad deal in order to avoid the tax penalty? And the answer is usually no. Because you're going to have, if it's a long-term capital gain, which most 1031s are, the vast majority are, then you're going to be paying 24% at the top, 23.8, or I always round to 24% state, federal, and usually average state rate is going to be 5-6%. So let's call it 30% all in on your gain. So is it worth paying, or is it worth buying a bad deal in order to avoid a 30% gain tax? And it depends, right? It depends on how bad a deal is it, right? And the thing about real estate is because it is so illiquid, if you get into a bad situation, it can go against you in a hurry. So a lot of commercial real estate guys are finding that out right now as the mortgage rates are being reset, because most commercial real estate are in 5-year arms. They'll reset every 5 years, basically, on interest rates. And when they bought the property back in 2019, rates were a lot less, 4%. And now they're a lot higher for commercial, 8%, 9%, 10%. And so the underwriting of the properties changes as the interest cost changes. And so what was a deal in 2019 is no longer a deal in 2025 just because of the financing underneath it. And if you run into a situation like that, then it would have been way better to take the 30% hit on the tax than it would have been to get into the bad deal and lose 100% of everything. You have to be really mindful of when you're doing these kinds of things, of the long-term ramifications, how exposed you are to interest rates, and then how bad of a deal do I want to accept if it's a rush job, and are these potential negative outcomes out there compared to my just paying the tax, right? So in a 1031, you basically have 3 months to identify the next property, and then 6 months, and then additional 3 months, so 6 months total to close on it. And it doesn't have to be one for one, so that's something to keep in mind. So you can identify a bunch of properties, and you don't necessarily have to close on all of them. So it's just like, hey, these are the ones that I'm wanting to look at, and then you can get your extra 3 months to close. But then if you don't close in 6 months, then it's just taxable. I thought it didn't depend, but it does.
Right.
Yeah, that's the basic idea there. I do. So in the real estate thing I put up here, 1031s are not included because we're talking about, this course is talking about operating deductions rather than purchase and sale kind of stuff. So it's unlocking those passive losses that are during the course of your ownership to offset other income rather than trying to minimize tax savings on, or minimize taxes on the exit. So just be aware of that.
Alrighty. Now we have another question under real estate. Someone wants to know if a landlord also uses part of their rental property for their own business, can they still do a cost segregation study?
For their own business, yes. So, if the business is a tenant, then that's fine. It's just like any other tenant. You gotta play fair though. So where people get into trouble is when they give special deals to, their business or like a family member or a friend or something like that. You got to charge market rates. As long as you charge market rates, everything's fine. But if you give yourself a sweetheart deal, then you can run into potential issues. It could be considered a gift. It could be considered income. It's just weird stuff happens. So just charge market rates and you're fine.
Right.
Now, if the landlord himself or herself is actually occupying the property, then you have to discount out that personal use portion of the property, and then you can segregate the rest for investment purposes. So that's a little wonky. That's not something we see very often. It could happen.
Alrighty. So it looks like we have a captive insurance question. So a client wants to know, is setting up a captive insurance company a good tax strategy for high income business owners, or is it too much of a hassle?
There's a little bit of hassle to it, for sure.
I was going to say that too.
Yes. So what captive is, or it goes by different names. There's 831s, there's captives, there's reinsurance. All these different terms are the same basic strategy. So what it is, there are special rules for insurance companies. When you pay a premium to an insurance company, that premium is not income for the insurance company. The insurance company takes that premium in, and they have, on an actuarial basis, they have a liability on the other side. So it almost operates like a loan. And what they do is they take that premium money, they invest it into something. It's usually bonds or real estate or something like that, something very humdrum and not too volatile. And the gains on the investment are taxable income to the insurance company. The way captives work is that you have a micro insurance company of your own. And there's a lot of rules that go into this as far as, how much coverage you have to have. You have to have a certain percentage on any one client of that micro insurance company. Basically, there are providers out there that organize all this for you and, match you up with different pools of insurance in order to make sure you comply with all the rules. So basically, your operating company will take out an insurance policy with your insurance company, and the operating company will pay the insurance company a premium. It's a high dollar premium because these are things you cannot buy insurance for in the normal marketplace. So I can go out and I can buy insurance. I can buy property insurance. I can buy a number of different types of insurance, but I can't insure against the risk that Amazon turns off my listing if I'm an Amazon seller. I can't buy an insurance policy that, so-and-so savages my reputation online. So these kinds of risks, they are business risks, and I can't go out and just buy insurance to cover it. That's where the captives come in. So they write these kinds of policies, and the actuaries do all their calculations as far as, what an appropriate amount of coverage is and what an appropriate amount of premium is for that coverage and all those kinds of things. So your operating company will then pay that premium, and it's just an insurance expense to the operating company. So it's going to lower your taxable income by whatever that premium is. And then it is not income to the insurance company because, again, special rules for insurance. So the insurance company then creates a policy, takes that money, usually puts it into, like I said, something very safe and liquid, that they'll be able to access that capital if they need to make a payout. And then usually after 1 or 2 years, then that money, that insurance policy will expire, and then that capital is freed up, assuming there wasn't a claim. If there was a claim, then you pay out to the operating company. If there wasn't a claim, which most insurance policies do not pay out because the insurance, the whole idea is to create pools against unlikely events. And there's such a thing as insurable risk versus uninsurable risk, which is beyond what I want to talk about right now. But most of the time, the insurance company does not pay out. And so now after a year or two, it's left with a pot of money that this premium was. So now the question is, what do we do with it? And basically at that point, there are options to reinvest it into something else, into another investment. You could take a dividend as the owner of the insurance company because these have to file as C corporations. And so at that point, you have your choices. And regardless of what you choose to do at that point, it is going to be a lower effective tax rate, either possibly 0%, possibly half of whatever your ordinary rate is. And that's just because of the structure of how the payments work and the time delay of everything. The question was, is it a good idea? And the answer is, if you have business risk that you can't insure or you can't buy a standard policy for, and you don't need the cash flow because you're basically locking these premium payments away into this insurance policy for 1 or 2 or 3 years, whatever it is, then yeah, it works out great. You got to play by the rules. You got to use a reputable insurance carrier that's going to help you organize all this, because again, there's a lot of specifics that go into it. But yeah, it's a great strategy if the situation works for you. So most important things is that, one, you need a lot of income, because these insurance companies don't want to mess with you if you're too small. Second thing is, you don't need all your money. You can live on a lesser amount of cash flow than the business could throw off. But if those things satisfy, and obviously the insurance risk issue. So if those 3 elements work for you, then great. Let's talk about it.
So it depends.
It does depend. Yeah.
Okay, understood. And it looks like we have an S corp question.
Uh-huh.
Someone wants to know, if someone has an LLC taxed as an S corp but wants to go back to a regular LLC, what do they need to do and how does it affect their taxes?
Yeah, you can revoke your S corporation election. It's almost never a good idea. Almost never. But I have seen it happen a couple of times. So this one client I was talking to today, she is shutting down her business, but she still has payables that are due to her, and she's in the physical therapy business. So she works on people with car accidents and things. And she's not seeing patients anymore, and she's not really operating, but she has prior work that the cases are still outstanding with the lawyers, and maybe she gets paid somewhere down the line. In that kind of scenario, it could make sense to terminate the S corporation election and then just pull it in as a disregarded entity on your Schedule C, because you don't need all the formalities. You're just waiting on payment, maybe, right? But yeah, you can revoke your S election, and then what you can't do is you can't go back and forth. You can't swap 1 year and then the other year. There's a 5-year or 60-month window where you're locked into your decision. That's the only thing. I've only seen a handful of revocations in my tens of thousands of tax returns that I've worked on, but you can do it. It's just a checkbox on your final S corporation tax return. You can check a box saying revoking, and then you would file an 8832, which is going to elect some other status, basically. But it's just paperwork. There's no fees or anything with it. There can be issues actually with assets that are held inside the S corporation that can be construed as a distribution. And if you have basis issues where you don't have enough basis to absorb that distribution, that can be an issue. So it can get gnarly, but yeah, you can do it. So
it can be done.
It can be done. Yeah, but very rarely would it be a good idea.
Understood. Looks like we have an Airbnb question.
Uh-huh.
Someone wants to know, if someone rents out their home on Airbnb, what's the best way to keep personal and rental expenses separate from each other?
It depends, right?
It depends.
I've seen it, and it really depends on what exactly you're doing. So I've seen people who, like in the early days of Airbnb, they would just rent out a room, right? And people still do this, but it's not as popular as it used to be. So they've got 4 bedrooms. They're not using one. One bedroom is available as a rental, and people come in and go out throughout over time. I had one client tell me that that's what they were doing. That was pretty much all their income, actually. And she was saying that they had crazy stories from people doing that, because you're sharing your home with these random strangers, effectively. So that's one scenario where you're just renting out a room or a floor or whatever, and you're still there. But the other scenario is that you are leaving for a time, and while you're gone, you rent out the place, right? So either way, what you have to do is you have to separate out the expenses. The revenue part is no problem. It's whatever came in through Airbnb, that's your revenue. But the expense part is going to be apportioned. And if they're going to be sharing the space, then it's going to be a percentage apportionment based on space. If you're leaving for a couple of weeks and renting out the whole place, then it's going to be apportioned based on time. If I leave for 2 weeks out of February, that's 1/2 of the month. So I can take my monthly expenses and divide by half, and I can get a number that way. Another question comes in is, do you want to depreciate? Because as an investment property, you are entitled to depreciation. But as a practical matter, you may not want to. And you'll hear people talk about allowed or allowable. That's not actually a problem anymore. That was fixed several years ago. But if you depreciate the business use of your property and then you go to sell, normally when you sell, you get a personal use exclusion of either $250,000 if you're single or $500,000 if you're married filing joint. But if you have business use in the history of that, you have to recapture that business use, and that does not apply to the personal use exclusion. And so then you're going to have a 25% recapture tax on that business use deduction that you got however many years ago. Depending on the numbers, depending on what your future plans are, you may not want to depreciate, and you may want to just pick up the extra tax on that so that you don't have to pay a recapture tax when you sell. Again, it depends. How does that 25% recapture rate compare to your regular rates? And most people, I would say the average federal tax rate that people pay is either going to be 22% or 24%. Usually 25% is going to be higher. That's something to consider. But if you're going to sell 10 years from now, well, take the deduction now. And then time value of money is going to be better off in your pocket rather than waiting 10 years. If you're going to sell next year, maybe you don't want to depreciate. So that's a consideration to put in there. But yeah, so you got to, whatever method that you use, you got to figure out what expenses are, the word is allocable, which expenses are allocated to that rental use and which are personal use. And you got to separate them out that way. So that's the basic idea. How you do that depends on what you're doing, what expenses you have, and all that kind of stuff.
So another, it depends question.
Yes. Every question is it depends.
Right. Understood. It looks like we have a crypto question. So it looks like someone asked, if someone runs a business that gets paid in crypto, what's the easiest way to handle their taxes?
Okay. The short answer is there is no easy way.
I was going to say, no easy way, guys.
Okay. So what happens in crypto? So crypto, how do I want to say this? Okay. Back 12 years ago in 2013, the IRS found out about Bitcoin and they stuck a flag in the sand and they said, for tax purposes, we're going to treat this as property. And everything since then has been in line with that announcement. Now, today, David Sachs was on TV talking about the regulatory framework that they want to put into place around crypto. So this might change. But for the moment, cryptocurrency is property. Somebody pays you in Bitcoin. And they pay you $100, $100 US worth of Bitcoin, and it's 0.0001 coins or whatever. And so that $100 becomes revenue to you, and you have to book it at the current market value of $100. Now, then you have an asset of a piece of property called Bitcoin, and however many tokens of it. And let's say 3 months goes by, and you sell that asset, and it has appreciated from $100 to $125. So now I had $100 of ordinary income, ordinary revenue to my business. And now I also have a $25 capital gain because it went from 100 to 125. So the issue is that the tracking of all that is very difficult. There are software programs that try to do it. None of them do a good job that I've seen anyways. The tracking programs do a good job if all you're doing is buying and selling on an exchange. That they can handle. But anything more complicated than that, receiving crypto for your business is more complicated and they don't track very well. You have to effectively manually, you have to recognize income when it comes in, and then you have to recognize capital gains transactions, whether it's a gain or a loss, on a separate event, and you have to track your basis along with that. That's the basics of it depends. It gets more depending because cryptocurrencies are fungible, meaning that if you receive one token of whatever, XYZ coin, and then you sell one token of XYZ coin, is it the same coin? maybe not. Depends on your accounting method. It depends on whether you choose to do last in, first out, first in, first out, or specific lots. And the IRS released some guidance last year saying you got to pick, right? They want you to pick on a wallet by wallet basis, which makes no sense, but whatever. If I receive one XYZ coin and I sell one XYZ coin, I have to determine where did that one XYZ coin that I sold come from? Was it the one I just received, and does it have that cost basis, or was it a different one that I received earlier, or was it what I received later, and is there a different cost basis? So that just adds to the complexity. And the short answer is there is no easy way, just because it's the systems that currently exist are not built for tracking things at this level. That's really the short and sweet of it. If you're trading on an exchange and they're tracking all that for you as though it were a stock, that technology exists. But if you're doing it, on your own outside of the exchange, then it's really hard. And there are companies out there that will compile reports for you. There was one that we talked to called Moontax, and they charge, I think it's 50 cents per transaction to compile the report. So if you have 10,000 transactions, it's like $5,000, which you might need to do anyway, but it's obviously very expensive at that point. So you got to make sure that you are making enough money to make the administrative burden worthwhile. Now, that's all to say that there's all these rumors floating around right now that they're going to make Bitcoin tax-free. And when David Sachs was talking today, he was saying NFTs are collectibles. That's actually not new. Last year, the IRS Chief Counsel released a report saying that you have to do a look-through analysis on NFTs to see what they represent and then tax them accordingly to that. It's a rapidly evolving area in law and in tax, and we will keep you updated. But at the moment, that's the treatment that you would have to go through.
All right, sounds good. Looks like we have a just for fun question here.
Okay.
If you had to explain taxes to a 5-year-old, how would you do it?
I have done this. So
I was going to say, yes, you have done that.
What I would explain to 5, she was like, I think she was 6 when I explained this to one of my kids. And she was trying to understand what taxes are. And I said, okay, when you earn money, and we have to establish what earning money is, one's a part of that. And obviously the immediate reaction is, that doesn't sound fair. It's like, what did the government do? And that's a whole other conversation you can have about whether you are getting good value for your tax dollars. But fundamentally, that's what it is. You earn money, government wants a piece. Now, in U.S. law, under the Constitution, with the 16th Amendment, only income is taxed. There are all these proposals you've seen floated out by different people talking about a wealth tax and talking about an unrealized gains tax. All this stuff is, at least as far as I'm concerned, not legal at all because it doesn't qualify as income. And there's this little niggling problem that income is not really defined anywhere, but that's an issue for the courts to decide. So that's the American system, is that when you earn income or when you receive income, you don't have to earn it necessarily because earning has its own technical meaning. The government wants a piece. Now, why do they want a piece? Because they say so. Why do we do it? Because they have lots of guys with guns who are willing to put you in a cage or possibly kill you if you don't.
That's true.
Because there is a difference. Most tax issues are civil issues, meaning the worst they can do is they can fine you and then they can go after your assets if it were to be established that you owe this amount of money, right? So they could grab your boat, they can grab your bank account, they can grab this, that, and the other. They can put a lien on your house, all that kind of stuff. So that's for civil issues, which is the vast majority. Criminal tax problems come in with tax evasion and fraud and things like that. You'll see online every so often that people talk about, it's like, why do IRS agents carry guns? The ones that carry guns are the Criminal Enforcement Division, and that's what they're going after. It's people who are committing criminal offenses in the tax world rather than just civil offenses. Every once in a while, we have a big enough country that it happens often enough, but a small percentage of people will be doing criminal offenses when it comes to the taxes rather than civil offenses, even if they get something wrong. For that kind of stuff, it's like real police and real jail and all that kind of stuff. And if you were to resist arrest during all that time, you might not make it. So fundamentally, the enforcement arm of the government is there to make sure that people file their taxes. And the IRS does their own reports on this kind of stuff, and they estimate there's an 85% voluntary compliance rate, meaning that 85% of the income in the US is reported on a tax return somewhere and or is actually paid the tax associated with that is actually paid. And they have a 15% non-compliance rate, which could be hiding income, not reporting, or just reporting and then not paying. So that's what they call the tax gap. How reliable is that 15% number? I have my doubts, but that's what they say. So that compliance pressure is really why you have to do that. And explaining all that to a 5-year-old is probably more than you want to get into.
Yeah.
But yeah, so the one sentence is, if you get income, government wants a piece, and you got to pay him. And if you don't, bad things happen. So that's it.
Understood. Looks like we have a real estate question again. Someone wants to know, how does someone qualify as a real estate professional for tax purposes, and why does it matter?
Okay, so that actually is in the course that I put up today.
Yep.
That is in Module 3, and I don't want to press play, but basically there's a couple different criteria. So real estate professional status allows you to elect non-passive real estate status. And that unlocks a whole lot of deductions potentially. So that's why you would want to do it. And maybe not, it applies to you. But, and this course will actually walk you through whether you need to do this at all or not. But what qualifies you is you spend at least 750 hours on real estate activities and at least 50% of your working time on real estate activities. And that's the one that gets people the most. And what qualifies as real estate activities? It's this list. It's a real property trade or business. It's a trade or business that does any of the following with real property: develops or redevelops it, constructs or reconstructs it, acquires it, converts it, rents or leases it, operates or manages it, brokers it. The reason this status exists, which is separate from the 8 other tests for material participation, is because material participation is just you interacting with your rental property directly. These other things could be other real estate activities not related to your particular rental property. And so that's where we're able to bring in more hours. So if you're a real estate agent and you're brokering, then you are adding those real estate hours, and then that might unlock the deduction strategies for the real estate that you do own. And so you got to satisfy the hourly tests and the percentage tests in these categories, right? Along with your direct real estate property experience throughout the year. So that's what real estate professional status is. And then the reason to do it is to unlock more deductions. A couple things is that if you're an employee of a business that does these things, doesn't count. So if you are, we've got one client who is a mortgage broker, but she works as an employee. So all of her employment hours do not count towards having a real property trade or business because she doesn't own it. She's just an employee. It's got to be your own business, or you're an independent person doing these things in trade or business covering these topics. You got to keep logs. This is something the IRS will ask about. Say, okay, you claim professional status, so you unlocked all the deductions. Great, let's see your logs. And they have to be contemporaneous, meaning that they don't want you to compile everything at the end of the year. They want you to have a log throughout the year showing that you were taking recordings as things were happening. So those are the qualifications for real estate professional status, and that's why you might want to do it. It's just you can unlock more deductions and save money on taxes.
So be very careful how you do the logs, right? Because you have to do it monthly.
I mean, really, you should do it every day that you do something, honestly.
Oh, wow. Okay. Alrighty. Understood. So it looks like we have an S Corp salary question.
Uh-huh.
A client asks, can an S Corp owner pay themselves their whole salary at once to get their tax break, or does the IRS not allow that?
It can be done. It's often not the greatest idea, but yeah, it can be done. They're not real thrilled with it, but yeah, the processing will go through just fine. You're better off. A much more common cycle that we'll see is quarterly. So the difficult part about being an S Corp owner and having your salary and everything is that business is volatile. Some months are good, some months are bad. Some years are good, some years are bad. And you want to adjust your payroll the year based on business conditions and based on what you're actually doing, rather than trying to assume a whole year's worth of activity. Because one of the things that goes into what's your reasonable compensation is what are you actually spending your time doing? Because as a business owner, there's the product or service that you sell, and then there's everything else that goes into running a business, right? And as the owner, you're probably doing all of those things. And each one in your market for your industry is going to have a different associated hourly rate. And so you want to get a weighted average of all those different things in order to come up with a real number that is reasonable for your compensation. So if I spend, let's just say a 40-hour work week, if I spend 10 hours doing administrative work, just internally files and whatever, that's going to be one pay rate. And then I spend another 10 hours doing marketing, creating ads and sending out email blasts and all that kind of stuff. That's going to be another rate. And then I spend 10 hours doing sales of one-to-one to somebody who's already a marketing qualified prospect. Then that's going to be, and then there's the actual, I got to sell this thing. I got to do the thing that I'm actually selling. That's going to be yet another rate. And you got to weight all those by pay rate and by amount of time you spend doing them. And so that's all going to change dramatically throughout the year as business conditions change throughout the year. A shorter cycle is better than annual, but yeah, it can be done. They will cash the checks that you send in on the 941s. So there's that.
So it can be done, guys, right?
Yeah.
So it looks like we have an audit question. Someone wants to know, if they were to get audited, does that put them on the IRS radar for future audits? And will it make them more likely to be audited again?
Yes.
Yes.
And it depends on the nature of what it is that got audited. There are things that are automatic. If you get audited for claiming a child that's not yours as a dependent, let's say, this used to happen a lot more back in the old days before they had auto-verifying social security numbers. People used to trade kids back and forth. It was not good. If you got audited for that issue, and then in a future year you claim a kid, then you have a much higher chance of getting audited on that, just because this is such a big issue and the tax credits are involved and all this kind of stuff. If you get audited on, I don't know, like the real estate hours thing. So if they want to see your logs and you provide them your logs and they say, great, then maybe you have a higher chance in the future of getting audited, but it's not the kind of thing where it's like an automatic. Back before the Tax Cut and Jobs Act, when we used to be able to take non-reimbursed employee expenses, we had a lot of highly paid employees as clients that had to spend a lot of money out of their own pocket to do their jobs. They were like sales reps and headhunters and this kind of stuff. They'd fly around the country, they'd take people out to dinner, and they had to do all this stuff in order to get, clients. And we would take this as a non-reimbursed or an unreimbursed employee expense, 2106 expense. So this one couple in particular that I can remember, they got audited on this issue, and the IRS wanted proof that it was required for their business, that they had all these expenses. They wanted proof of the expenses themselves and all this kind of stuff. And so they came in, I remember they came in with a 4-inch 3-ring binder of documentation. And we mailed it off to the IRS, and they pretty soon dropped it after that. But in that kind of thing, when you are really strongly demonstrating that you are right and you are doing things within the rules, then at least historically, I have not seen any evidence that raises your audit risk over time. Depends on the thing, but a lot of the stuff that people get audited for will continue to carry risk on into the future.
So it does depend. It looks like we have a behind-the-scenes question.
Okay.
So what's the hardest part of working in tax planning that people don't realize?
Oh, that part's easy. The hardest part is getting accurate information. So a lot of times, if you go to taxsherpa.com, you click book an appointment, you'll get a call with Serena, and she'll do the survey call. And the survey call is when we talk about your situation, and she'll gather your numbers and say, okay, I'm married, I've got a house, I've got a job, I've got this, that, and the other. And then we bring all that back to the team and we work on a plan for you. And it's a rough plan because we're not deep diving into the numbers. And we'll say, okay, based on the numbers you're giving us, then we could do this, that, and the other, and we could save you, $20,000, $30,000, whatever the number is. And so that's one level of difficulty because a lot of people just don't know their numbers. I'm making this much on this rental property, and then we look at the tax return from last year. It's not making that much. Or when we get farther into an engagement and we need actual documentation, people are just very slow to get it to us, and that slows down the whole process. So right now we're in tax filing season, and for some clients we talk to throughout the year. That's what we prefer. And for them, there's no real issues because we're up to date with everything. Mm-hmm. For the people we see once a year, they're sending us files, and then we're starting tax returns, and then we're missing this, that, the other. So like one today, and this was my own fault. The guy was here in the office. He was missing a couple forms, and he said he'd send them in. He did send them in. And then I realized when he was here, I forgot to get his birthday. So now we're just reaching out to him to get his birthday so we can put that number in the tax return. It doesn't change the numbers at all. We need it for filing. So it's always those little things that we're missing. And a lot of times we're just like missing one thing, one form from a client. A big one is the Obamacare form, the 1095A. Listen to me now, anybody who's thinking about filing tax return. If you had Obamacare, then you need to include your 1095A. And that is the statement from the marketplace showing how much you paid, how much they paid, and what the second lowest cost silver plan was for your zip code and your family status. It's, just key information that is needed. And so in the old days, what used to happen was we would send in a tax return not knowing that the client had Obamacare, and it would get accepted. And then they get a letter 6 weeks later saying, hey, you didn't include your Obamacare. So we need that information in order to process your return. And then, that takes an extra 2 months or whatever. So these days, most of the time, the IRS will actually reject the tax return first and say, hey, you didn't include your Obamacare. So that's actually progress.
Yeah, that's true. Save time, at least.
saves time, yeah. But yeah, the hardest part is definitely getting complete and accurate information from people. And whether that's on the planning side or on the filing side, both are the same issue.
Alrighty, so we have a real estate question. A client wants to know, can a homeowner rent out their house, their business for meetings and get a tax break?
If you do it right, yes. And that's the Summit Strategy session. Summit Strategy sessions. And this gets into the code section is 280 AG2. You can do it as long as you follow the rules, right? You can only do it 14 times a year. There are certain guidelines on what kind of entity can do that, because you can't rent to yourself. But if you have a separate entity for tax purposes, not just a separate entity for legal purposes, those are two different things, then you can do it. And you got to be appropriate about it. You got to charge market rates and all these kinds of things. But yeah, it can be done. It's a great strategy. And the way we do it is, how do I say this? The two ways people screw this up are, one, they charge outrageous numbers that's not backed by market data. And two, they don't actually have a business purpose for doing it. They're just doing it for the tax deduction. Here's a life pro tip. You can't do things just for tax deduction. You got to have a business purpose. And so the way we have developed our strategy is to have management meetings for your business. And we have a whole process that you go through as far as how to have your meeting, what to do at the meeting, what documentation to create from the process of the meeting in order to justify all that. Yeah, it can be done. And honestly, it should be done, because you should be doing this kind of management work on your business. As a matter of course, it'll make you a better business owner. It'll make you more money over the long term. And at the end of the day, you'll actually end up paying more in tax because you will be making more money. Now, when you get to that point, there's a whole other set of strategies that we bring in to eliminate that issue, but that's further down the road.
Alrighty. Looks like we have another business question.
Okay.
So someone wants to know, if they own two businesses, can they share expenses between them to save on taxes?
In most cases, it doesn't matter whether you share them half and half or 95-5 or whatever, because the vast majority of businesses are flow-through entities, meaning that are going to be the ones who are picking up the income, the net income, which is revenue minus expense. And then they're going to be paying their individual tax based on whatever that number is. So if I have $5,000 of expense in company A and zero in company B, when it gets to me as a flow through, then it is still $5,000 in expense. If it's 2,500 and 2,500, still 5,000 in expense. If it's 1,000 and 4,000, still 5,000 in expense. As long as we're talking about pass-throughs, usually doesn't matter. Now, if they have different ownership structures between different entities, then it can matter. So if one is a partnership and you're only 50% and you're 100% on another S corp, then yeah, you want to make sure that you are getting the full bang for your buck, and your partner in that other company isn't siphoning off your deductions. Also, if you have a non-pass-through company like a C corporation, then it definitely matters because they're totally siloed. You got to be mindful of what money's going where and to whom, and as long as you follow those kinds of guidelines, then the net result is going to be the same either way. Now, with that said, it is a good idea to apportion things accurately, because especially when it comes to, even though it doesn't impact your current year taxes, it will impact your sale potential. Because, when you go, the biggest problem when people try to sell their businesses is having accurate books. So if you have a clean set of books that is accurate and actually reflects the performance of that business, it is a much easier sale than if it's like, $5,000 comes in over here, but this other company that I have over there is really paying for the phone system for this company. So we got to work that in. And it's a whole lot of cover, or the other way around. It's, this expense, it's on this business, but really it belongs to this other business. So really my net profit should be higher and I should get a higher sales price as a result. Those are hard conversations to have and make negotiations more difficult. So you want to accurately reflect the performance of that business so that when that time comes, you can make a very simple representation in a sale process. So that's the main reason to do it. If you want to be super thorough, a lot of times what we'll see is if somebody has like a portfolio of businesses, we'll have a management company that actually leases out employees and resources to the subsidiary companies. And that way the flows are fully accurate. So again, it doesn't change anything on the net, but what it does do is it puts the expenses where they belong in the different company structures. So that's, again, it's more administration, but if you have a portfolio of companies, you're just dealing with more administration. That's just how it goes. Be careful what you wish for. And on top of that, there is another concept that I don't think enough people comprehend or put into place, and that is the concept of economic value added. So basically, every business operation should have a profit. And what that means is that, so let's say we're going through that management company that leases out employees and resources and everything to subsidiary companies. I've got a marketing guy, right? If I'm renting my marketing guy to my subsidiary, I need to be renting that not at cost, but at profit. So if my marketing guy costs $50 an hour or whatever, I'm not going to be selling him his time to my subsidiary for $50 an hour. I'll be selling him his time to my subsidiary at $75 an hour, so that I am making sure that I am, one, representing a true cost if I went out on the third party market to replace that function in that subsidiary business. And two, I need to make sure that is still profitable enough that it's worth doing. Because if it's not worth doing, then you have to look at other solutions, and you shouldn't have that person in-house. When you force yourself to focus on the business unit profit, it a lot of times reveals that you're just wasting money that you could be done in other ways or cheaper or just eliminate entirely when you actually take a real close look at it. That's just, again, that's not a tax issue because revenue on the one side will show up as expense on the other. It's a wash, but you want to make sure that from business operations side of things that you are doing things the most efficiently that you can. Yeah, it depends.
It depends.
All right, I'm gonna cut it off there because we only got a couple minutes left. And what's the next step? So the next step is become an explorer. Go to taxsherpa.com/explorer. You sign up. It's free. You get stuff like this course that I put up today. And there's AI tools and there's worksheets and there's all kinds of stuff. For the explorers, a lot of it's free. Some of it's paid. Here's a pro tip. If you want to go to one of the paid offerings, you're better off just joining the Navigators, which is our premium community. And that's actually, in the Navigators, you get everything, plus a whole bunch of other stuff. But for the explorers, a lot of free tools. And you're able to submit questions on these kind of calls. And you'll be the first to know about our workshops and all this kind of stuff. Definitely sign up. And then, we'll do it all again next week. What is next week? Next week is the 11th. So 11th, and then 2 weeks from now, on the 20th, we're actually having another webinar on the shred method. And the shred method is a super cool tool about getting rid of your interest expense in life. And the two biggest expenses in our financial world are taxes and interest. So taxes we pay to the government, interest we pay to the banks. And people, especially over the last decade or so, when we were in the zero interest rate environment, have been really confused about interest. And they say, my mortgage is only 4% or 3% or whatever, and my car note is 2.9 or whatever the number is. It's like, how does that actually work out that I'm paying so much in interest? Is because it's not the percentage interest rate that matters. It's the volume of interest inside of the payment that matters. And that depends on whether you're interest only, or amortizing, or all these different things. And what the shred method does is it gives you a tool to mathematically maximize your reduction of interest, and it gives you tools to supercharge that. It's really cool stuff. I'm looking forward to it, and we're doing that on the 20th at 8 p.m. If you're an Explorer, you'll get an email, and then you can sign up for the webinar at that point. But yeah, overall, go to taxrobot.com/explorer, sign up, and you'll get access to all of our tools, all of our information, all of our upcoming events, access to questions for these kind of shows here. Yeah, we'll do it next week. All right. With that, I'm going to call it, and we'll see you next time. So thanks, everybody. Have a good one.